Over the past 3 years, Singapore banks have been flying high as they were fueled by a high interest rate environment that boosted their net interest margins and profits. In contrast, REITs have not been doing so well due to rising debt costs. But with the Federal Reserve now starting to cut rates and signaling more cuts ahead, will the banks finally T-boom while REITs take off to the moon? Alright, let's talk about the Singapore banks first. To see how much the banks have grown, all you got to do is compare today's numbers with where they were just a few years ago. So back in 2021, when interest rates were basically zero, DBS made about $6.8 billion in net profit for the full year, while paying a total dividend of $1.20 per share. Fast forward to 2025, and the picture looks completely different. In just the first half of the year alone, DBS had already delivered $5.7 billion in net profit. That is nearly what it used to make in an entire year. Okay, I know there's a big gap between $6.8 billion and $5.7 billion. But still, this just shows you how far they have come. At the same time, they have also declared a 120 cents dividend plus an extra 30 cents in capital return. Even if we exclude the 30 cents special dividend, DBS is already paying out the same amounts of what it used to pay in an entire year. Likewise, both OCBC and UOB tell a similar story. Since 2021, both banks have seen earnings growth significantly and have nearly doubled their dividends. But now, things are starting to slow down. Firstly, net interest margins have fallen across all three banks. In the latest quarter, DBS NIM has fallen from 2.14% a year ago to 2.08% now. OCBC saw a bigger drop to 1.98%, while UOB came in at 1.96%. Naturally, this has affected their interest income. In the first half of 2025, DBS net interest income fell by 1% year-on-year. OCBC dropped by 5%, while UOB managed to stay flat, at least for now. That's also why banks have been cutting their deposit interest rates. When the rates that they can lend at come down, they can't keep paying depositors the same juicy yields anymore. For instance, remember back in 2022 when OCBC pushed its interest rates all the way to 7.65%? Those were the fun times. But by 2025, they've already cut it not once, but twice, down to 5.45%. Then at the bottom line, while DBS has managed to keep its net profit steady year-on-year, both UOB and OCBC saw declines of -3% and -6% respectively. At the dividend level, things aren't looking so great either. Even though DBS has continued to raise its payouts, both OCBC and UOB have already started to trim their dividends. And with all three banks currently paying out 50 to 60% of their profits, there's little room for error if earnings continue to soften. Quick pause. If you're looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry at just 35 cents per trade on the US stock market. It also offers Ireland domicile ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. However, with that being said, not everything is bad news. For one, while net interest margins have indeed gone down, loan growth has actually started to improve. This is because as rates start to come down, the cost of borrowing has become cheaper. As a result, homeowners and businesses are now more willing to borrow again. So this increase has partially helped to offset the fall in net interest income. But even more importantly, the banks aren't just mainly relying on interest income anymore. Instead, non-interest income is now playing a bigger role in driving profits, especially from wealth management. In the first half of this year, DBS wealth management fees grew by more than 30% year-on-year, and today, it already makes up nearly half of its total fee income. And it's not just DBS either. Both UOB and OCBC have also seen strong growth in wealth management fees, trading income, and others. So what does this all mean? In the near term, things may get a little bumpy. For example, while DBS has guided that its 2025 net interest income will be slightly lower than 2024, they also warn that their overall net profit may fall due to the new global minimum tax and higher provisions. Same for OCBC and UOB, which both expect their net interest income to decline too. But here's the silver lining. Even though the Fed has only just started cutting rates, SORA rates in Singapore have already been trending down since last year. What this means is that the bulk of the NIM squeeze may already be behind us. and unless there's some economic slowdown or a recession, margins could stabilize a lot sooner than what many people might expect. However, with that being said, all three banks are currently trading at a rich valuation. DBS trades at more than 2 times book value, while OCBC and UOB are closer to 1.2 times. These are all above their long-term historical averages. While this does not mean they will immediately boom and crash tomorrow, it also means that they are currently priced for perfection. And in order to continue maintaining these high multiples, the banks will need to keep outperforming. But if they underperform, the stocks could come back down. So it all comes down to how much the net interest income continues to drop and how much the non-interest income is able to grow to make up for it. So what does this mean for investors? If you already own the banks, I don't see a need to rush and sell, especially if you have bought them around $30 to $40 before this whole run-up. With dividend yields this high, you are essentially getting paid a 4 to 5% yield just to hold. But if you are thinking of buying at today's valuations, I would be a little cautious. The upside looks limited for now, while the risk of a pullback is higher. Next, let's talk about REITs. So, over the past 3 years, REITs have been falling, mainly due to the higher interest rates environment. But in April this year, it looks like the sector may have finally found a bottom and has actually started to climb back up. In fact, back in May, the REIT index was just trading at 0.85 times price to book. This was lower than its 10-year average of 1 times price to book. In other words, the sector as a whole was undervalued at that time. But after the rebound, it is now sitting closer to its 10-year average. So it is fairly priced now. That said, not all REITs moved the same way. There's been a clear divergence between the strong names and the not so strong ones. Take for example, while names like CapitaLand Integrated Commercial Trust, Capital REITs and Parkway Life REITs have gone up by over 10% year to date, other names like Manulife US REITs and Lipo Malls have continued to drop, despite the rates coming down. And the reason for that is simple. Quality REITs with steady rental income and growing DPUs did better, while those with high debt and tenant issues kept struggling. What this shows is that not all REITs are created equal. Out of roughly 40 REITs in Singapore, only about 10 can really be considered quality names. These are the ones you want, because they not only stay resilient when times are bad, but also continue to grow when conditions improved. So, how do you identify the good ones? Here are a few key criteria I use. First, I want to make sure that the REITs are able to increase their revenues and dividends over the long term. For example, here you can see that this REIT has consistently increased their revenue year after year. And here, you can see that the REITs have increased their dividends year after year as well. Now, it doesn't have to be consistently increasing every year, because there will be some years that are bad. But overall, you want them to be able to increase their revenue and dividends over time. Second, their gearing ratio must not be too high. In Singapore, the gearing ratio limit is at 50%, but ideally, you don't want it to cross 40 to 42%, because if the debt is too high, that's when they will get into trouble. And lastly, you want to avoid REITs that have high dividend yields, because if the yield is too high, it tends to be a value trap. The reason is because dividend yield is inversely correlated to share price. So typically what happens is that when the REIT is bad, its share price gets sold down. That tends to push the yield up. So it gives a false impression that the yield looks high, when in reality, it is just the stock price going down, because nobody wants to invest in it. Ideally, you want a yield that's below 7 to 8% to be safe. So how do you go about applying these criteria? One tool that you can use is Mumu's Stock Screener tool. This video is not sponsored by them. I just find it to be super helpful. So here's the Stock Screener tool. You can first filter the sector by REITs. And here, you will see that there are 39 REITs here. Then let's add revenue growth. Let's say I want an average revenue growth of at least 0% over the past 5 years, meaning it can't be negative. After that, let's also add the dividend growth rate. Let's say over the past 5 years, the dividend growth rate must be at least negative 5%. Okay, I know it should ideally be a positive number, but I wanted to give a little bit of leeway as the past few years weren't that good to REITs. Next, let's add the gearing ratio filter. Mumu doesn't have a gearing ratio. Instead, you can use the debt to assets ratio. So let's say over the past 1 year, the gearing ratio should be less than 50%. Again, I know we want it to be less than 42%, but I realize Mumu's numbers for this is a bit off. For example, for Mapletree Logistics Trust, their gearing ratio is around 41%, but in Mumu, they gave it a 47.8% debt to assets ratio. So I just wanted to give this a higher leeway as well. Finally, let's also add the dividend yield filter. Let's say I want the yield to be no higher than 8% to avoid dividend traps. And ta-da! We have just shrunk the number of REITs from the original 39 to just 10 names. For example, Parkway Life REITs has consistently increased both their revenue and dividend. Their gearing ratio isn't too high either, and they are in a line where the business will continue to do well regardless of whether times are good or bad, because people will still have to visit the doctor, and with an aging population, their nursing homes will always be in demand. Likewise, Fraser's Centrepoint Trust also fits the profile and has a resilient portfolio of suburban retail malls. However, just like with any stocks, you want to avoid buying when it is overvalued. So for REITs, you can look at the price-to-book ratio. For example, Parkway Life REIT currently trades at about 1.69 times price-to-book. This is in line with its historical average. Meanwhile, CapitaLand Ascendas REIT is currently trading at 1.25 price-to-book, which looks a bit pricey when compared to its historical average. This isn't too surprising, given that Ascendas is one of the largest and most established REITs in Singapore, so investors are often more willing to pay a premium for its stability. Okay, here are my thoughts. Banks are looking a little expensive right now. To justify their current valuations, they will need to keep delivering strong results quarter after quarter. That's not an easy task, especially in a lower rate environment where margins are under pressure. That said, if you already hold bank stocks, there's really no need to rush out and sell. Singapore banks have done a great job diversifying their income sources, especially into wealth management, and that makes them more resilient than before. Plus, their dividends remain attractive, which means you are still getting paid to hold them. On the other hand, REITs are now finally making a comeback. As interest rates come down, their financing costs will ease, making the distributions look more sustainable and attractive again. But remember, not all REITs are equal. Some are well managed with strong sponsors and prudent balance sheets, while others are weighed down by debt and poor assets. This is why picking the right REITs will be important. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.